Welcome to Iron Financial. Our job here is to stress test companies, cut through the market noise, and help you forge a stronger portfolio. Today, we are putting on the hard hats and taking a deep structural look at Moody's Corporation. After their latest earnings report, the buzz is deafening. But our question is simple. Are we looking at a rock-solid fortress built to withstand anything, or is this just a shiny glass facade that's going to shatter at the first sign of trouble? Let's get to it.
Okay, so let's get right to the headline number that's got everyone talking. A massive 20% jump. For the full year 2025, Moody's cranked out adjusted earnings per share of $14.94. That is a 20% increase year over year. On top of that, revenue hit a record $7.7 billion, up 9%. Now, on the surface, these are the kind of heavy-duty, powerful numbers that demand attention. They blew past analyst estimates, and the growth is undeniable. But you know how we operate here at Iron Financial. The headline is just the shiny paint job. We need to inspect the foundation, the steel beams, and see what's really holding this thing up.
Yeah, 20%. It looks fantastic on a slide, no doubt. But come on, we've all seen this play out before, right? A company throws out a massive growth number, the market goes wild, and 6 months down the line, we find out the whole thing was held together with duct tape and wishful thinking. So before we get too excited, I need to know what's really underneath all this. What's the actual steel frame supporting that number? Is this durable growth we're seeing, or is it just a one-time sugar high from a good quarter in the market? That's the real question we need to answer.
Right. And that is exactly why we're here. We've got our inspection plan laid out, and we're ready to go. We're going to break this company down piece by piece, methodically. First, we're going to examine the two foundational pillars that hold the entire structure up. Pillar 1, the old-school powerhouse, their ratings division. Pillar 2, the modern, new-school growth engine, their analytics division. Then, when we're done with that, we're going to put the most hyped part of their story, their big push into artificial intelligence, on the stress rig to see if it bends or if it breaks. And only after we've inspected every beam, every joint, every weld, will we deliver the official Iron Financial verdict. So let's start with the absolute bedrock of this company. Pillar 1 is Moody's Investor Service, or MIS. I mean, this is the original business, the brand name that everybody on Wall Street knows. You can think of this as the core steel frame of the entire financial world. For over a century, if you were a serious player and you wanted to issue debt, you needed their stamp of approval. This is the traditional, foundational business that provides immense structural support for the entire corporation. This is where their reputation was forged in iron. And just to give you a sense of the sheer scale we're talking about here, look at this number. $6.6 trillion. That is the amount of debt that the MIS division rated in 2025 alone. That is an all-time record high for them. I mean, just let that number sink in for a second. This is not some boutique shop. This is a core utility of the global capital markets. This massive volume, which supports everything from new airports to AI data centers, forms the unshakable bedrock of their revenue. When the markets are active, this pillar doesn't just hold its own weight. It generates immense financial force. Now, this is where it gets really interesting, because this chart tells a critical story about where the recent power came from. In the fourth quarter of 2025, that traditional MIS ratings business, the old guard, saw its revenues climb a massive 17% year over year. Now compare that to the 9% growth in their more modern analytics business. Both numbers are good, don't get me wrong, but this tells us that the constructive market conditions, that surge in debt issuance, did the heavy lifting to close out the year. It shows that the old-school powerhouse still has incredible torque and power. Okay, a 17% pop is strong, I'll give you that. But isn't it also tied directly to issuance volumes? That can be incredibly volatile. The market gets choppy, debt issuance dries up, and that number can go right back down just as fast as it went up. So is this legacy business really maintaining that kind of momentum on its own, or did they just get lucky with a good market wave in Q4? I need to see if there's real new growth here.
That is the crucial point, and it's about more than just riding a market wave. This is about elite-level profitability. The margins in this legacy business are incredibly wide. We're talking 63.6% adjusted operating margin. And importantly, they are still expanding. That's mastery of operational efficiency. And they are not standing still. They are aggressively pushing into new high-growth areas like private credit, which is absolutely booming right now. We're talking a 60% surge in private credit revenue. They are landing huge exclusive deals, like being the sole rating agency on a massive $1.5 billion private credit CLO from Blackstone. That's not just riding a wave, that's building a bigger, faster boat.
All right, let's pivot and move to the second pillar and see how this part of the structure is built. This is Moody's Analytics, or MA.
Now, if the ratings business is the foundational steel frame, you can think of MA as all the advanced self-sustaining systems inside the building. We're talking about the modern electrical grid, the high-speed data pipes, the state-of-the-art security infrastructure. This is the segment of the company that is specifically designed for durable, scalable, and predictable growth, and it's meant to complement and balance out the more cyclical nature of the ratings business. Make no mistake, this is their future.
And this chart right here, this brilliantly illustrates the quality of this side of the business. Just look at this. In the fourth quarter, a staggering 97% of the revenue from the Moody's Analytics segment was recurring. Let me repeat that, 97%. This is not transactional, one-and-done business. This is subscription-based revenue from software, from data feeds, from analytics that are so deeply embedded into their customers' workflows that they're almost impossible to rip out. This is the kind of high-quality, predictable revenue stream that investors prize above almost all else because it provides incredible stability and visibility into the future.
Let's be crystal clear about what this really means. Durable, scalable, predictable. That 97% recurring revenue figure is the key indicator of structural integrity for this half of the company. It means they're not just selling a product. They are selling a utility, an essential service. Customers are signing multi-year contracts because these tools are absolutely essential for their core operations, things like risk management, regulatory compliance, and making credit decisions. This creates a powerful compounding effect and a solid foundation for consistent long-term growth, and it insulates them from the wild ups and downs of the debt issuance market.
So where exactly is that recurring growth coming from? If we pop the hood on that $3.5 billion in annual recurring revenue, it's not just one branch of the business carrying the load. It's broad-based strength across their entire analytics portfolio. We're seeing solid, consistent growth from their banking solutions, their research platforms, their data feeds. But the real standout, the area that is showing absolutely explosive growth, is their KYC, Know Your Customer business. It's up 15%. I mean, just think about it. In a world with increasing regulation and financial crime, providing the tools to verify exactly who your customers are is a high-demand, high-growth, mission-critical service. It shows they are positioned perfectly to capture some very powerful long-term market tailwinds.
Okay, that's a solid story, but hold on a second. I was digging through their filings and I saw that they've been selling off parts of this very business. They recently divested their learning solutions and their regulatory reporting businesses. So the big question for me is, are they strategically sharpening their focus here, or are they quietly cutting away muscle because it wasn't performing? Divestitures can be a red flag that a company is just trying to cosmetically improve its growth profile by jettisoning slower parts. Are they actually weakening the overall structure? That's a sharp observation, and it's absolutely critical to understand the strategy here. This isn't about weakness. This is about discipline. CEO Rob Fauber was crystal clear about this on the earnings call. These moves are a deliberate strategic shift. The learning solutions business was primarily transactional revenue, which, as we've seen, they are actively moving away from. The regulatory reporting business had limited cross-sell opportunities with their core products. So by selling them, they are concentrating their capital and their talent on the core, high-growth, high-margin areas we just discussed, like KYC and their lending solutions. This is about improving the overall quality and scalability of their revenue base. It's trimming fat to build more muscle where it really counts. Okay, so we've inspected the two main pillars. The foundation is solid, and the growth engine is humming. But now we move to the most hyped part of the story. The part that could either be a revolutionary structural innovation, or it could just be a lot of hot air. It is time to put their AI narrative under a serious stress test and see if it's just hype or if it's actually heavy metal. This is it. This is the question on every single investor's mind right now. Every company on the planet is talking about AI. It's in every single press release, every conference call. But you know what? Talk is cheap. I want to see the proof. I want to see the money. Is this AI story translating into actual dollars and cents? Or is it just a buzzword they're slapping on everything to pump up the stock price? Forget the talk. Show me the tangible impact on the business. Show me the revenue. I can do better than that. I'll show you the data directly from their report. And this isn't a forecast or some hopeful projection. This is a look at actual customer behavior right now. Customers who have adopted at least one of Moody's new Gen AI or Aginex solutions are being retained at a near-perfect 97% rate. But here's the real kicker. Their spending with Moody's is growing at roughly twice the rate of the rest of their entire customer base. So the crucial point is this. AI adoption isn't just talk. It's a powerful tool for customer stickiness and for expanding wallet share. This is the very definition of a pricing power lever, and it's a huge leading indicator of future revenue growth. Okay, that's compelling data, I'll give you that. But it's still a little high level. Give me a real-world example. What is a specific, tangible product that's actually doing this? I want to see the tool, not just the statistic. What's it called?
Perfect. Let's look at Credit Lens. This is their flagship AI-enabled lending solution. It is an end-to-end digital suite for banks that automates pretty much everything, from ingesting financial data to generating credit memos and monitoring risk. It's a tangible AI application that is being sold, deployed, and is driving significant results for their clients as we speak.
And the proof is right there in the product's performance. The Credit Lens platform on its own is seeing phenomenal growth, approaching 20%. Now, check this out. When existing customers come up for renewal, a huge portion of them, about 2/3 of those eligible, are choosing to upgrade to the new AI-enabled suite. And when they do, Moody's sees a massive uplift in the contract value, an average of 67%. This is direct, quantifiable revenue coming from AI. And it's having a real-world impact, with major Tier 1 banks reporting that Moody's AI tools are saving their analysts, and I'm quoting here, hundreds and thousands of hours of work. That's not hype. That's a direct return on investment that banks are clearly willing to pay a significant premium for.
All right, we've inspected the ratings foundation, we've examined the analytics growth engine, and we've put the AI story through a tough stress test. We've gathered all the evidence. Now it's time to put it all together, synthesize this information into our final inspection report, and issue the official iron financial verdict on the structural integrity of Moody's Corporation.
So here is the balanced summary, the bull versus the bear. The bull case is powerful. You have record performance in 2025, you have two distinct growth engines firing on all cylinders, and you have the incredible stability of that 97% recurring revenue in the analytics division. Add to that the proven, concrete monetization of their AI strategy, strong margin expansion, and very confident guidance for the future. On the other side, the bear case points to real risks. This company is not immune to geopolitical and macroeconomic shocks. The ratings business is still dependent on debt issuance cycles. The AI landscape is fiercely competitive, and they face near-term revenue headwinds from the divestitures we talked about. These are the cracks we have to watch.
And let's not just gloss over those risks. That dependence on debt issuance is a very real double-edged sword. We saw how much it helped them in Q4, but a slowdown in the credit markets could just as easily turn into a powerful headwind. And the AI competition is not sleeping. They have deep-pocketed rivals. Those cracks are small right now, but they can widen fast under pressure.
Okay, so that's the lay of the land. We see the strengths, we see the risks, but what is management's plan to navigate those risks and build on these strengths? What's the actual blueprint for 2026?
Their guidance for 2026 is a huge statement of confidence. They're projecting revenue to continue growing in the high single-digit percentage range. Critically, they see their adjusted operating margin expanding another 150 basis points into the 52 to 53% range, which is just massive. They're guiding for adjusted EPS of $16.40 to $17, which implies another 12% growth right at the midpoint. And they are backing this all up with cold, hard cash, planning to repurchase approximately $2 billion worth of shares. This is not a company that's hunkering down. It's a company with a clear and confident plan for continued construction.
So, we've completed the full inspection. We've kicked the tires, we've stress-tested the frame, and the iron financial verdict is in. Moody's Corporation is a structurally sound opportunity. The analysis of its foundational ratings business, its highly durable and scalable analytics engine, and its clearly monetizable AI strategy shows a company that is built with high-quality materials. The pillars are strong, the systems are modern, and the forward-looking blueprint is solid. I have to admit, the inspection holds up. My initial skepticism was all about the substance behind those big headline numbers. But the deep dive really proves this isn't just a shiny facade. When you look at the elite margins in the ratings business, that near-perfect recurring revenue in analytics, and the massive contract uplifts they're getting from the AI upgrades, those are hard-to-ignore proof points. The steel frame and the advanced systems are solid. The numbers check out. And that brings us to our final thought. The evidence suggests the company's structural integrity is sound. It is built to last. So the whole conversation has to shift. The question is no longer if Moody's will grow. The real question, the one that we're going to be watching for the next few years, is how effectively can it leverage its fortress-like balance sheet and its AI roadmap to fortify its competitive moat. Because as AI threatens to commoditize generic data, their ability to remain the indispensable provider of unique, decision-grade insights will be the ultimate test of their long-term dominance. That's the real story to watch. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a